Ooh. Hello? Hey Mohnish, yeah, it's Tom here. How's it going? Good. Thanks for getting back to me. No, that's no worries. Hey, I just wanted to give you a quick ring. You probably heard on my voice message, but you know, we've all got day jobs, and I was hoping you could share some investment ideas with us. We haven't all got time like you to you know, look into these things, read annual reports, and have an afternoon nap. Just come on. Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So, unfortunately that wasn't Mohnish on the phone, that was me just playing along. I wish I had Mohnish's phone number and I could have you on to him, but unfortunately I don't. But luckily enough, we don't actually need Mohnish's phone number or anything to find out what he's been buying, at least in America. So, he recently actually sat down and did an interview with a magazine called Graham and Doddsville, and if you think that Graham and Doddsville sounds familiar, that's because Warren Buffett actually put together now quite a famous article called The Super Investors of Graham and Doddsville, which is basically all about these investors that came out of the school of Columbia University and Ben Graham's sort of value investing teachings, and they all had phenomenal sort of investment performance records. So essentially, each quarter, Columbia puts out this newsletter magazine type thing called Graham and Doddsville, and this quarter they actually interviewed Mohnish Pabrai. So I'm going to leave the link to that down in the description. I've just printed out the few pages that Mohnish is sort of included on here, and I want to run through sort of three really big learnings. There's a lot of gems in here, a lot of really good stuff. Mohnish can always get some great ideas across very quickly and concisely, so I'm not going to go through everything in here by any means, but I'm going to go through two of my main learnings from this interview, and then at the end we're also going to go through basically the one kind of massive stock tip that Mohnish actually gave in this interview as well. And just full disclosure, I do actually already own the stock that he was talking about in this, so if I come across as biased at all, you know why. I own it. So first off, let's get into the first couple of big lessons from Mohnish, and then we'll get into the stock tip towards the end. And as always, just before we dive into this, any kind of stocks that we talk about on the channel, any companies, they are not recommendations from me by any means. Even if I own it, don't just go out and buy it just because I own it, or don't sell it just because I'm selling it or anything like that. This is simply giving you my opinion, my perspective, and running through actually a lot of Mohnish's opinions here as well. So without further ado, let's get into it. So a little bit of background just before we dive into this first point. Mohnish Pabrai got into investing at the age of about 30 years old. He just basically made his first $1 million from selling a little bit of his IT company. He had $1 million in the bank, and he had no debt for the first time in his sort of professional career. And it was at that point, and all of this background is sort of in this interview as well, but it was at that point that he really discovered the world of value investing and Warren Buffett. He originally read a Peter Lynch book, then he read another Peter Lynch book, and Peter Lynch kept talking about this guy called Warren Buffett, and Mohnish had no idea who the guy was, and he went in and discovered that Warren Buffett was obviously a very successful investor, still is incredibly successful, but really Warren Buffett discovered two things at a very early age. The first one is that compounding is the eighth wonder of the world, and if you can compound with a long runway and do that for a long period of time, and you can compound at a high rate, then you can't help but be very rich over the long term. So one of the questions that sort of came out of that, and this is our first kind of big learning from this interview, is the sort of interviewer from Graham and Doddsville asked Mohnish, you talk about compounding and trying to compound for a long time, but you don't have a lot of the traditional compounders in your portfolio. So if you don't know what that means, essentially a compounder is a type of business that can continually make profits, produce a high amount of cash flow, and then redeploy that cash flow within the business to continue growing. So a good example of this would be something like Facebook. They've made something like 30% return on invested capital for about 10 years. So basically every time that they make a profit from 1 year of operating in that business, they funnel that money back into Facebook to expand the platform, to add new features, to buy Instagram, acquire other companies, do that sort of thing. And these companies can just grow and compound over time. They become more profitable, and they kind of snowball up. So there's not a lot of those types of companies actually in Mohnish's portfolio. So the interviewer basically asked, what's going on here? You're talking about compounding, but you don't own any compounders, or traditional compounders at least. So Mohnish said, that's an extremely interesting question, and this is actually something I've done a couple of videos on before. And Mohnish basically says that investing is not necessarily about finding great companies, it's about finding great investments, and oftentimes there's a big difference between this. So Mohnish often brings up the example of Coca-Cola. So if you had bought Coca-Cola in 2000 and you still held it today, the underlying business of Coca-Cola has continued to compound, and it's done very, very well. What happens with Coca-Cola though is price matters. So if you'd bought Coca-Cola in 2000, you would have bought it at about 40 times earnings. And if you look at Coca-Cola today, I'll put the exact number on the screen, but it's around something like 20 times earnings today. So the multiple of earnings has doubled, but the multiple of earnings is halved, but the amount of earnings has around about doubled. So you've roughly stood still, even though the underlying business has done well. So it's not necessarily always about trying to find great businesses, it's about trying to find great investments. So that's the first big learning, is that regardless of business quality, price matters, and regardless of how poor a quality a business is, if it's selling at a really cheap price, that can potentially be a really good investment as well. So that's the first point. Let's get into learning number 2. So learning number 2 from this interview with Mohnish Pabrai is to never touch leverage in stock market investments. Basically what that means is don't take out debt to invest, don't do anything like that ever in the stock market. So leverage and mortgages and that sort of thing, they certainly have their place in things like real estate investing. They can be an extremely powerful tool in something like real estate. But when it comes to the stock market, there are some real dangers with using debt. So if you're not familiar, when you borrow money to invest in the stock market, that's something called a margin loan. Similar to a mortgage in a lot of ways, you pay an interest rate on the amount of money that you borrow, and you can take that money and you can use it to invest in the stock market and accumulate more assets. So in that way, it's very similar. The thing that makes margin calls really dangerous is that unlike a mortgage, the margin loan is callable. So what that means is when you've got a margin loan, you have to actually keep there's a minimum equity requirement with your sort of overall investment portfolio. So let's say that equity requirement is 50%. What that means is if you have $1,000 of your own money and $1,000 in a margin loan, then you have 50% equity. So the total is $2,000 and you own $1,000 of that, so 50% equity. And if you go ahead and invest that, then you can invest $2,000 and you can reap the benefits of growth on $2,000. What happens though is if that stock goes down, let's say it goes from $2,000 and it goes all the way down to $1,000, so you've made a 50% loss, all of a sudden you still owe $1,000, but you have an equity of $0. And with margin loans, basically the bank or whoever that lender is going to want you to keep that equity percentage at a minimum of 50% or whatever that percentage is, like I just said. So there's really 2 options if you ever get into a situation like that and you've got a margin loan. Option 1 is you deposit more cash. So you have to have a spare $1,000 that you can put back into that margin account to lift your equity back up. Or what happens with a lot of people, and this is the point where you can get into a lot of trouble, is you're going to be forced to sell. And this is something that Mohnish brings up the example of a guy called Rick Guerin. So I'm going to put up the performance record of Rick Guerin. He was actually included in the Super Investors of Graham and Doddsville article by Warren Buffett, and he jumps out as, I'm pretty sure he actually had the best performance record in that entire article, something north of 30% a year compounded, and I'll put the results up. But essentially, Rick Guerin almost went bankrupt. Rick Guerin was crushing the market, and he had higher returns than everyone else, really because he used leverage, he used margin. And it was great when the stock market was going up and he was doing very well. He was able to, outperform Warren Buffett and Charlie Munger and all these insanely talented investors. But when he got to the stock market crash in the early 70s, basically Rick Guerin was getting all of these margin calls, and he was having to sell a lot of stock, including actually Berkshire Hathaway. And Mohnish brings up this example of Rick Guerin actually having to sell Berkshire Hathaway shares. So I'm going to put the Berkshire Hathaway stock price on the screen. Many of you will already be familiar with it, but it's something north of $300,000 per share at the moment. In the 70s, Rick Guerin was forced to sell his Berkshire Hathaway shares due to a margin call at around $40 per share. So just let that sink in for a second. If he didn't have that margin call and he still held those Berkshire Hathaway shares today, his money would have multiplied by over 1,000 times since the 70s. So pretty bad situation to be in. And Warren and Charlie basically always say, we knew we were going to be rich. We knew it was just a matter of time. We weren't in a hurry to get there. And unfortunately, Rick Guerin and a lot of other people that do take out margin and leverage in the stock market, at least, they are in a hurry to get there, and it can get you in a lot of trouble. So those are the two big tips from Mohnish that I really got out of this interview. So for the third point, I'm going to get into basically the new stock that Mohnish has been buying. And again, full disclosure, I own this. Don't take this as a stock recommendation or anything like that. But I want to kind of run through the logic and some of the reasons why Mr. Market is pricing this company pretty cheaply at the moment, in at least mine and Mohnish's as well, personal opinion. So let's get into that. All right, so the company that Mohnish has recently been investing in, if you check his 13F, he's put right around $50 million into the stock, which I believe is roughly 5 to 10% of his portfolio, somewhere in that range. Essentially, the company is called GrafTech International, and if after I've gone through this, if you are really interested in learning more about GrafTech International, there's a couple of resources that helped me in my sort of studies of this company, so I'll quickly recommend those to you. So the first one is obviously just the GrafTech annual report to get it straight from the horse's mouth with what's happening at that company. The second one is there is a actually unlisted YouTube video, so it's a little bit tricky to find, but if you go to Mohnish Pabrai's website, which is called chaywithpabrai.com, I'll put that link on the screen or in the description below as well. If you go to Chai with Pabrai, Mohnish recently did an interview. I'm going to forget the name of the people he did it with, but again, I'll put it somewhere either on the screen or in the description box down below. At about 42 minutes in from memory to that interview, he talks about this new company that he's buying and the reasons why he's buying it. At that time, he didn't disclose what the company was called, but if you're in the loop with GrafTech, it's pretty obvious that he's talking about GrafTech in that situation. So that's the second one. The other one I would recommend is there is a podcast called the After Dinner Investor podcast. Search that up. He's also a big sort of Mohnish Pabrai fan, so you're getting a few biased sources here, but check that one out, and he does a full basically analysis of the business of GrafTech. He's supposed to have another episode coming up soon on pricing and that sort of thing, but that's a really good analysis of the competitive advantages, what's going on with pricing in that industry and how the business basically makes money and what the investment case is. So that's the After Dinner Investor podcast. And then the fourth one, if you want a bit of a counter opinion, head over to Sven Carlin's YouTube channel. He also went through basically the investment theory, and he was near enough right on the money in my opinion at least. But this is a company that Sven was a little bit more bearish on. He thinks probably a little bit too risky for his personal preference. So there's a few different sources if you really want to get into the detail. But in terms of what's in this article, so basically Mohnish was talking about this steel company that he invested in back in 2004 called IPSCO. So IPSCO was a company that had no debt. They had about $15 a share in cash on their balance sheet, and they actually had contracted revenues for the next 2 years. So with their contracted revenues, and they actually came out and said what their free cash flow was going to be for the next 2 years, which is quite rare. And they said their free cash flow was essentially going to be around $15 per share each year for the next 2 years. So you've got 15 in cash, $15 earned in year one, $15 earned in year two. Total is $45. And the stock was basically trading for $45 in 2003, 2004 kind of time. So the big reason why it was trading so cheaply is essentially that the steel industry that IPSCO was in is a very, very cyclical industry. So basically after year two, there was really no visibility at all with what earnings and free cash flow were going to be. There was a chance that earnings could go negative, but there was a big margin of safety in terms of the first couple of years of earnings, and then the fact that there was no debt and there was kind of cash on the balance sheet as well. So what ended up happening with that investment is Mohnish went in relatively heavily. What also happened is IPSCO came out about a year later and said, you know, we're going to have another year of $15 of free cash flow. We've got another year of visibility on earnings. At that point, the stock went from 45 to 90, so it near enough doubled. And a little bit after that, another company came in and bought out IPSCO. They bought in an offer at $160 per share. So Mohnish sold basically as soon as that announcement came out. The stock went straight to like 150. He sold in the 150s, didn't even think twice about it. So he made basically a 3x on that investment, and he sees GrafTech as a pretty similar investment. Not quite as attractive as that, but definitely a lot of similar qualities. So GrafTech is also in the steel industry. They're not a steel manufacturer or anything, but they produce these graphite electrodes. So if you want to produce steel, there's really two ways to do it. Either you can use iron in a blast furnace, or you can use scrap metal in an electric arc furnace. And GrafTech really operates in that electric arc furnace kind of area of steel production, and they essentially sell these big graphite electrodes that can withstand the very, very high temperatures in that electric arc furnace steel production. So GrafTech sells those electrodes. There's a lot of interesting things going on in the electric arc furnace kind of area at the moment. So the first thing is that prices for graphite electrodes are extremely high right now, and that's really been driven by a couple of things. The big one being demand actually for pet coke. So pet coke is actually a petroleum kind of byproduct that is used to make these graphite electrodes, and that is in very high demand actually because of electric vehicle production as well. So the price of petroleum coke has gone way up, and that's meant the price of graphite electrodes has gone way up. And one of the interesting things that GrafTech have done is they've actually gone out to their customers, and they've said, you know, prices are extremely high right now. There's a chance they could go even higher. So how about you lock in some prices for the next 3 years? And basically, they've locked in contracted revenues, contracted free cash flows for about 70% of their production. So they've still got about 30% of their production that'll just be sold on the spot market, but about 70% of their revenue is pretty much locked in these take or pay contracts. So that's fantastic. Has a lot of similarities again to IPSCO. We're probably going to get our money back in 3 years, even if the stock does nothing. We're probably going to get that back in dividends and buybacks and that sort of thing. We're probably going to get 70 to 80% of our money back fairly quickly. And again, if GrafTech can come out with another year or 2 years of visibility, then there's a chance that we can get a nice double or triple potentially on this investment. So that's my quick run through of GrafTech. Again, if you want more detail, go and check out some of the resources that I've given you, but that is a very quick rundown on it. The reason Mohnish actually brought this up in the first place is he has this idea that investing is very simple but not easy. So it's very simple in terms of we're trying to assess the future free cash flows of a business and then discount that back and look at that versus the price we have to pay to get those cash flows. That concept is very simple. Figuring out what those free cash flows are going to be can be very tricky. So in a couple of situations, we've got these sort of hacks where we can see that even if we have no idea what's going to happen after even year 2 in the case of IPSCO, or if we have no idea at all what's going to happen after, say, year 3 or 4 with GrafTech, Mohnish tells us that, we don't even actually have to try and work out the intrinsic value of GrafTech. He said he never knew what the intrinsic value of IPSCO was, but he knew where the floor was. So he knew at the very bottom end it was worth at least this, and he's buying it below the floor. So you can't help but do well unless things go horrendously wrong with investments like that. So that was a quick run through. I really hope you enjoyed the video. If you do want to read this full interview, I'll leave it down in the description with the various other things that I've recommended for you as well. So hope you enjoyed the video. If you did, hit like, hit subscribe, and I will see you in the next one. Cheers.